If the US economy and the S&P 500 both started at $100 in 1980, by the end of 2024, the US economy would be $321 and the stock market $5,448, 17 times the size of the US economy. That difference is staggering, but if you follow the news at all, this might not be that surprising. You often hear about stock markets growing at double-digit rates.
About 18% upside.
27%.
14.4%.
The annualized return of the S&P 500 since 1928 is about 10% including dividends and 6.5% without. On the other hand, economies of developed countries like the US grow at a much lower rate.
2.8%.
3.2%.
The annualized GDP growth rate of the US economy since 1948 is around 3%. But how is this possible? How can the stock market consistently grow faster than the economy? Will the stock market continue to grow faster than the economy forever? Or is the stock market overvalued and there's a crash soon coming? To understand how the stock market can grow faster than an economy, we need to understand what the stock market and what the economy are. When people refer to the stock market and whether it's gone up or down, they're usually referring to various indices, most commonly the S&P 500, the Nasdaq, or the Dow. These indices represent a collection of large publicly traded companies like Apple, Visa, or Coca-Cola. When the stock market goes up, it's because companies in these indices, more so than not, have increased in value. And why these companies will increase in value is generally because they are profitable or investors are optimistic about their future growth, and the opposite is true if the stock market falls. What the economy refers to is the total amount of production that occurs in a country. Formally, this is the total amount of spending incurred by consumers, businesses, governments, and exports net of imports. So for an economy to experience growth, it needs to produce more goods and services than it did in the previous year. And this is driven by increases in productivity, the labor force, or technological advancements. So going back to the first question, how is it possible for the stock market to consistently grow faster than the economy, keeping in mind that the long-term return of the stock market is around 10%, while the economy grows at around 3%? I think this question can be explained by going through a simple example. Imagine you are a shareholder of a company called ABC Corporation, a company that sold alphabet books. For the upcoming year, ABC Corporation is expected to sell 1 million books at $14 each, while incurring a variable cost of $10 each, giving them an expected profit of $4 million. And based on comparisons with similar companies, and because it gives us easier numbers to work with, let's say ABC Corporation has a PE ratio of 25. This means that the $4 million of expected profit translates into a $100 million market capitalization at the beginning of the year. A year later, all the financial statements have been written and audited, and ABC Corporation did end up with a $4 million profit they expected. As a shareholder of ABC Corporation, you're entitled to this profit, and ABC decides to pay out $3 million as a cash dividend and reinvest $1 million to grow the company. Now, because of this reinvestment, ABC Corporation is expected to grow slightly faster than the economy for the year ahead, at 4%. Compared to say 3% for the economy. What growth means in this sense is that they don't sell 1 million books this year, they sell 1.04 million books. So selling 1.04 million books at $14 and at a cost of $10 now gives a profit of $4.16 million. Applying the same PE ratio as before, ABC Corporation is now worth $104 million. Adding on the $3 million that was just distributed to you, ABC Corporation has generated a total return of 7%, while the economy has grown at 3%. So that's pretty good so far, but how do we reach the 10% that we're after? So at this point in the video, I have to admit that I've been slightly lying to you. The 10% average stock market return is correct in a nominal sense, but the 3% average GDP growth rate is real. In other words, it's been adjusted for inflation, so comparing the two isn't exactly correct. The GDP figures you see or hear on the news are reported on a real basis, whereas returns from assets are generally reported without adjusting for inflation. Inflation in the US averages around 3% a year, so if we were to inflation adjust the 10% average S&P 500 return, as you'd expect, it'd be around 7%, which is what we have, so we can stop there. Or if we were to continue with the bottom-up approach from before, as well as expecting the 4% growth in the new year, ABC Corporation also expects a 3% increase in their prices and costs, otherwise known as a 3% increase in inflation. So they will sell 1.04 million books at $14.42 and at a cost of $10.30, which gives them a profit of around $4.28 million. Applying the same PE ratio again, ABC Corporation is worth $106.09 million in nominal terms. Adding on the $3 million dividend, the stock has generated a total nominal return of around 10%. Again, this is while the economy grew at a real inflation-adjusted rate of 3%, or in other words, a nominal rate of 6%. So through this simple example, you can see how the stock market can grow faster than the economy. In the real world, analysts categorize the drivers of stock returns into three broad groups. First is dividend yield, which is how much of the company earnings are paid out to investors. Second is earnings growth, which is a function of company growth and inflation. Last is changes in valuations, which is how much investors are willing to pay for a company's earnings. Mathematically, this is any changes in the PE ratio. In the example before, the PE ratio was kept at 25 at every stage, but you can see that if the PE ratio grew to 30 or fell to 20, this would ultimately affect the total return of the stock market. In the short term, valuation changes can fluctuate wildly, with periods of optimism having higher PE ratios and periods of concern with lower PE ratios. In the long term, these periods mostly cancel out with each other, so the long-term effect of valuation changes in stock prices is minimal, which is why I skipped it in the example. These three factors can and do vary from year to year, and together they explain why the stock market grows the way it does. So these factors are able to show why the stock market can grow faster than the economy. But why does the stock market grow faster than the economy? Even in inflation-adjusted terms, the stock market returns around 7%, which is still higher than the 3% that the economy grows by. There are many reasons often provided for this difference, but I think it comes down to three main reasons. Firstly, the stock market is made up of the largest and most financially transparent companies, with executive teams who have the sole mission of pursuing growth and maximizing shareholder value. These companies have the market power to raise the prices and lower their costs, and attract the brightest talents to make them even more money. So naturally, the stock market will be able to generate earnings faster than the rest of the economy. Secondly, especially in recent decades, publicly listed companies have access to global markets that can boost their financial statements, but won't be seen in a country's GDP. For example, Amazon has a presence in most countries around the world. If a South Korean seller sells something to a South Korean buyer using Amazon, Amazon's profit increases, but this transaction doesn't increase the US's GDP. There's just nowhere it fits in the GDP formula. Lastly, and probably most importantly, the stock market and GDP simply measure different things, so there's no reason for them to grow at the same rate. This study from 2012 found that in many countries, the correlation between per capita GDP growth and stock market returns was actually negative. The authors noted several reasons for this, but I think this can be partly explained by events like the public release of DeepSeek R1 in late January 2025. When it was revealed that the AI model DeepSeek could rival the market leader ChatGPT at a fraction of the cost and power, stock markets around the world crashed. No longer was it necessary for AI companies to spend billions of dollars on Nvidia chips, and the big AI players like Google, Meta, and Microsoft seemingly wasted billions of dollars unnecessarily. AI, in a sense, became democratized, as even smaller companies with little access to funding could develop their own fully functioning AI models. While this is bad for the existing large players in the AI industry and the broader stock market, this is arguably good for the everyday people and the economy. Like, it's not hard to imagine that the release of DeepSeek and the possibilities that stem from its implications will increase productivity at a fraction of the cost of established AI models. So what was bad for the stock market will likely end up being a positive for the economy. The stock market and GDP simply measure different things, and that's okay. Now on to the final question. Can the stock market continue to keep outpacing the economy? Luckily, there's a simple answer for this. I don't know. No, Seriously, one of the first things you learn about the stock market is past performance doesn't guarantee future results. Although the stock market tends to grow faster than the economy, and it has logical reasons for doing so, it doesn't always. The 2000s was a decade famously known as the lost decade, as not only did the S&P 500 not return 10% annual returns, you actually would have lost money if you invested on the 1st of January 2000. Now, is this going to happen again? I don't know. Past performance doesn't guarantee future returns. But if you're wondering if the stock market can sustain 10% annual returns forever, well, forever's a long time, so something like that is bound to happen again if you're working with that time frame. Will it happen soon or even in your lifetime? There are a lot of articles, research and YouTube videos that think so, and I would probably get a lot more views if I made a dramatized thumbnail with fire and red downward arrows and create a flashy hook about how an imminent crash is coming. But the truth is, I, nor anyone for that matter, have no idea. You can make arguments for either side, and I might make a video about it soon. But the fact is that right now, the long-term annualized return of the S&P 500 is around 10%, and it's a number that's bigger than the long-term growth rate of the economy. And it's also a number that can either go up, down, or remain the same in the future. Thanks for watching the video. Please check out this video right here, and please also subscribe. Goodbye.